Now let's bring in former Federal Reserve Board Governor, Columbia University economics professor Frederic Mishkin. He is also a CNBC contributor. Professor Mishkin, you heard Steve's kind of state of play for the Fed. What exactly, in your mind, is the most important factor that the Fed is debating or deliberating about right now as it looks towards what is a presumptive 25 basis point rate cut?
So what's happening now is something that is always very comfortable for a central bank, which is where you have a stagflation type phenomena where inflation is high, rising because of a supply shock, in this case, the tariffs. But on the other hand, that supply shock also can actually weaken the economy. And so we're seeing exactly this scenario start to play out with inflation well above the Fed's target, particularly on the core level, which is more important for telling you what may happen in the future. That we're in a situation where the employment numbers are starting to look much weaker than they were before. And so this is a case where there's always a quandary, because if you're in a situation where there's a negative demand shock, and in that case, you're going to have both inflation and the economy weaken, then it's easy. You just lower rates. It's much tougher in this kind of environment. Normally, what a central bank should do is to recognize if the supply shock is temporary, in the sense of temporary to inflation, that's just a one-time shock, and that's what a tariff will do, then in fact they should look through the fact that inflation will be temporarily higher, but eventually come back down again. And it makes the case much more stronger for them to actually ease. The problem here is that the Fed's very worried about inflation expectations, and this is particularly very, very key in terms of the attacks that we've seen on the Fed, the Lisa Cook situation, the fact that they've appointed somebody which is unprecedented that actually still is keeping a job in the White House, which is really quite extraordinary, indicating that they'll be beholden to Donald Trump, who's asking for very, very dramatic cuts. So in this kind of situation, the Fed is very concerned that inflation expectations may not stay stable in this kind of environment. And that may be a key reason why they may be much more reluctant to cut rates faster than they otherwise would. And I think that's the problem that they're facing. Yes, there's a situation where it looks like the economy is weakening. The inflation rate, if in fact inflation expectations don't rise, that's a situation where it will be temporary rise in inflation. Then, in fact, they would cut and cut more deeply. But this is a tough situation for them.
All right, Professor, you mentioned inflation expectations. One of the big fears out there is that somehow inflation expectations do hypothetically rise and then kind of get anchored at higher levels and then incrementally kind of move up and drift higher over time. What causes that kind of phenomenon, and how can you avoid it with Fed policy and rhetoric?
So the Fed could do what it try to actually show that it's going to be serious. But the problem is, if you take away central bank independence, which is clearly one of the things that Trump has been advocating, then in fact people will expect that monetary policy will become much easier in the future. And this is a real possibility, not just with the appointment of Steve Mirren, but also the potential new Fed chair that will occur in May. And in that situation, what happens is that you actually have inflation expectations rise, inflation rises, and actually, by the way, ironically, that means higher interest rates. So we've seen this happen before, that we've seen this happen in Turkey, where the central bank independence was compromised, and look what's happened to them, very high interest rates. We see it, by the way, in a place like Argentina, where, in fact, there was a classic, the attack that we see on Lisa Cook, it's very similar to what was done in Argentina, where they attacked Pedro Po at a point before they had their financial crisis to get rid of him. They did get rid of him. And in fact, also fired all the people at their statistics department. So nobody trusted the statistics. And all of these are sort of the pattern we're in now. And it's a very scary one. And that actually is a situation where inflation expectations are much harder to contain. The Fed's really aware of that, and that's one of the reasons why they may be reluctant to ease as fast as they normally would.